Capital budgeting is a critical process for businesses of all sizes, from small startups to large multinational corporations. It involves making informed decisions about long-term investments which can significantly impact a company's future growth and stability. One of the most widely used methods in capital budgeting is the net present value, or NPV method, which is essential for evaluating investment opportunities. NPV helps businesses evaluate the profitability of potential investments by considering the time value of money, ensuring that future cash flows are accurately assessed. By discounting future cash flows to their present value, NPV provides a clear measure of an investment's potential profitability, making it easier to compare different projects. A positive NPV suggests that the investment will generate more cash inflows than outflows, resulting in a net gain and adding value to the company. The NPV method is a valuable tool for decision-making in capital budgeting, helping businesses prioritize projects that offer the best returns. In the following sections, we will delve deeper into the intricacies of NPV, exploring its calculations, applications, and limitations in greater detail. Net present value, or NPV, quantifies the value of an investment in today's dollars. It represents the difference between the present value of cash inflows and outflows over a specific period. In simpler terms, NPV calculates whether an investment is expected to generate more money than it costs. The formula for calculating NPV is as follows. Image formula for NPV. Cash flows, expected inflows and outflows of cash associated with the investment. Discount rate reflects the minimum rate of return required by investors. Time period, the lifespan of the investment. By discounting all future cash flows back to their present value, NPV provides a comprehensive measure of the investment's profitability. Calculating NPV involves estimating cash flows, determining the discount rate, and applying the NPV formula. Here's a step-by-step guide to help you through the process. 1. Estimate cash flows. Project expected cash inflows and outflows for each year of the investment's life. This involves analyzing historical data, market trends, and future projections to make accurate estimates. 1. Determine the discount rate. Select a rate that reflects the risk associated with the investment. This rate should consider factors such as the cost of capital, inflation, and the specific risks related to the investment. 1. Discount future cash flows. Calculate the present value of each year's cash flow by discounting it to year zero. This step ensures that future cash flows are accurately represented in today's terms. 1. Sum the present values. Add up the present values of all cash inflows and outflows. This gives you the total value of the investment in today's dollars. 1. Calculate NPV. Subtract the initial investment from the sum of the present values of all cash flows. This final step reveals whether the investment is expected to generate a positive or negative return. By following these steps, you can determine the NPV of an investment project. This calculation is essential for making informed financial decisions. This systematic approach ensures a thorough evaluation of potential investments, helping you to weigh the benefits and risks effectively. Accurate projections and appropriate discount rates are crucial for reliable NPV calculations. Without these, the results can be misleading. This method helps businesses make informed decisions about long-term investments, ensuring that resources are allocated efficiently and profitably. By mastering the NPV calculation, you can enhance your financial analysis skills and contribute to the success of your business or investment projects. Once you have calculated the NPV of an investment, the next step is to interpret the results. Positive NPV indicates the investment is expected to generate more cash inflows than outflows, resulting in a net gain. Negative NPV suggests the investment will result in a net loss, with cash outflows exceeding inflows. Zero NPV means the investment is expected to break even. Companies typically prioritize projects with higher NPVs as they promise greater value creation. However, NPV is just one factor in capital budgeting decisions. Other qualitative and quantitative factors should also be considered. This comprehensive approach ensures well-rounded investment decisions.
Section 5. Advantages of using NPV in capital budgeting. NPV offers several advantages as a capital budgeting method. First, it considers the time value of money. By discounting future cash flows, NPV accounts for the opportunity cost of capital. Second, it provides a clear decision criterion. NPV offers a straightforward rule. Accept projects with a positive NPV and reject those with a negative NPV. Third, NPV focuses on profitability. It considers all cash flows over the life of an investment. Finally, NPV maximizes shareholder wealth. These advantages make NPV a valuable tool for capital budgeting. Section 6. Limitations and drawbacks of the NPV method. While NPV is powerful, it has limitations. First, it relies heavily on estimated cash flows. Inaccurate estimations can impact NPV results. Second, NPV is sensitive to the discount rate. A small change in the rate can alter the NPV significantly. Third, it ignores non-financial factors. NPV focuses solely on financial aspects, missing qualitative considerations. Lastly, NPV assumes a constant discount rate. Despite these limitations, NPV remains valuable when used appropriately.
Section 7. Comparing NPV to other capital budgeting techniques. In this section, we will explore how net present value, or NPV, stacks up against other popular capital budgeting techniques. NPV is one of several capital budgeting techniques used to evaluate the profitability of an investment. Other methods include internal rate of return, or IRR. This method is widely used in financial analysis. IRR calculates the discount rate that makes the NPV of an investment equal to zero. It helps in understanding the efficiency of an investment. Then there's the payback period, another straightforward method. This method measures the time it takes for an investment to recover its initial cost. It's simple but doesn't account for the time value of money. Another method is the profitability index, or PI. This technique is useful for comparing different projects. PI calculates the ratio of the present value of future cash flows to the initial investment. A PI greater than 1 indicates a good investment. Lastly, we have the modified internal rate of return, or MIR. This method addresses some limitations of the traditional IRR. MIR assumes cash flows are reinvested at the company's cost of capital, providing a more realistic picture of an investment's potential. Using multiple methods can provide a comprehensive evaluation of investment opportunities. Each technique has its strengths and weaknesses, and understanding them can lead to better financial decisions.
Section 8. Real-world applications of NPV across industries. NPV is used across various industries for evaluating investment decisions. In corporate finance, companies use NPV to assess mergers, acquisitions, and capital expenditures.
Real estate developers evaluate property acquisitions and construction projects using NPV.
In the energy sector, NPV is used to analyze exploration and production projects.
Technology companies use NPV to assess software development and data center investments.
Startups leverage NPV to evaluate funding rounds and market expansion strategies.
Section 9. The role of risk and uncertainty in NPV analysis. Risk and uncertainty are inherent in any investment decision. It's crucial to incorporate risk considerations into the NPV framework. One approach is to adjust the discount rate to reflect the riskiness of the project. Higher risk projects typically warrant a higher discount rate. Another method involves conducting sensitivity analysis and scenario planning. This involves assessing the impact of changes in key assumptions on the NPV. Incorporating real options analysis can account for the value of flexibility in decision-making. By considering risk and uncertainty, businesses can enhance the robustness of NPV analysis. Section 10. Ethical considerations in capital budgeting. Ethical considerations are paramount in capital budgeting. It's essential to integrate ethical principles into the NPV analysis process. Transparency and accountability in cash flow projections and discount rate selection are crucial. Consider the broader societal impact of investment decisions. Integrating ethical considerations involves promoting responsibility, accountability, and sustainability. Businesses should strive to create value for all stakeholders, contributing to societal well-being. Section 11, Conclusion NPV, a powerful tool for financial decision-making. In conclusion, net present value, or NPV, is a powerful tool for capital budgeting. It provides a structured framework for evaluating investment opportunities. A positive NPV suggests that an investment is expected to create value. While NPV offers numerous advantages, it has limitations. To enhance NPV analysis, incorporate risk assessments and ethical considerations. By understanding NPV principles, businesses can make more informed and responsible capital budgeting decisions.